Ganado Advocates is a full-service law firm, so we basically handle the fund world on all aspects, be it on the corporate side or the regulatory side, or the compliance aspects. My department is made up of 10 professionals, and we basically focus mainly on setting up of fund vehicles in the jurisdiction, as well as setting up all the service providers to the fund vehicles themselves. The firm would basically focus on the drafting of the documentation, handling the process with the regulatory process with the MFSA, and assisting the promoters of the fund structure to basically launch the fund out there on the market and raise the capital. From 2001 onwards, when we actually introduced a rule book for alternative investment funds, what at the time we used to call and still call professional investor funds or PIFs, we had a split in the framework between the typical retail stroke UCITS fund and all types of alternative investment funds. Following the introduction of the AIFMD in July of 2013, we saw this becoming even clearer. So today we have a very specific set of rules which regulate any form of alternative investment funds. And what the MFSA has been doing now over the past couple of years is actually introducing bespoke rules regulating funds with particular investment strategies, such as lending funds or private equity funds. These are the typical two where there's a rule book in place. In case of the private equity funds, it's still in consultation, whereas in case of the lending funds, it was issued a number of months ago, thus giving more flesh to the bones arising from the AIFMD, and being able in this manner to direct fund promoters to specific rule books regulating their particular investment strategy. Most of the structures domiciled in Malta are umbrella funds with a number of sub-funds within them, each one basically focusing on either a similar area or a different area, different investment strategy. And a typical feature of Maltese law is that each sub-fund has its assets and liabilities segregated from those assets and liabilities of each other sub-fund within the umbrella structure. So you can basically create an umbrella fund where certain groups of investors go into one sub-fund but not into another, and they would still be protected, their assets would still be protected if any of the other sub-funds in the umbrella structure goes belly up. These umbrella structures are typically then set up in a corporate form, which is what we call the CCAV. The CCAV is typically a variable share capital company, so where the shares do not have nominal value, but the value of the shares is the net asset value of the company itself. And the CCAV structure, stroke umbrella, has been used for all forms of investment strategies, be it real estate, private equity, long short, long only, whatever it is. It is so flexible that it is able to accommodate any type of strategy. Malta regulates, Malta's fund framework regulates the fund itself. So when it comes to alternative investment funds or PIFs, the professional investor funds, they are able to accommodate any form of investment strategy. I think the ones which seem to gel well with the regulatory framework over the past few years have been real estate and private equity funds. In the case of private equity and real estate funds, you can actually be a little bit more creative, because you can even have self-managed structures where the investment decisions relating to the implementation of the strategy can be taken by the board of the fund itself. I think initially we were looking at the AIFMD as a directive which could have prejudiced Malta's fund framework because of the additional rules which it introduced. As I think over the last year, we have concluded that it is really another opportunity for Malta to enhance its fund offering. What the AIFMD, the way in which the AIFMD has contributed to the jurisdiction is put it more on the map as an alternative investment fund domicile than it was before the AIFMD came in, where alternative investment funds were not harmonized at EU level. The AIFMD has also created opportunities for bespoke structures to be set up, particularly on the, again, I repeat, the real estate and private equity fund side. And on the self-managed fund side, there are opportunities available within the directive to also structure fund vehicles as self-managed, i.e., they wouldn't be delegating their day-to-day portfolio management to a third-party fund manager, but they would be assuming responsibility themselves for the investment decisions. And with the tax exemption which exists in Malta for all fund vehicles, as it is all over the EU in other countries, this presents an opportunity for a fund promoter to actually have a tax-neutral structure in the jurisdiction, which could, subject to the fulfillment of a number of conditions, even be passported across the EU and sold to professional investors. I think we need to build on the blocks which we have at the moment, which is the introduction of more bespoke structures targeting specific investment strategies for fund promoters. I think Malta would struggle if it were to try and compete with the other traditional fund domiciles in the, for instance, long-only space. Because the opportunities and the experience of the other fund domiciles in that space could be used as a positive factor for a fund to essentially not domicile in Malta but in these other jurisdictions. I think due to the size of the jurisdiction and due to the size as well of the funds which are being set up in Malta, which typically are around the 50 million mark starting, 50 million euro mark starting, Malta's strategy should be to go for the bespoke structures, such as structures for family offices, structures for ultra high net worth individuals, or even structures which are managed by the private banks, typically in countries like Switzerland.